You may recognize the music from Joe's because this is a Halloween release, but it's also an evergreen topic. It's about yield and the pursuit of higher yield. And it's meant to be a scary episode for investors. But for regular listeners, you may also recognize the theme from the usual Dvorak Symphony of the New World, a symphony that's a very optimistic piece of music inspired by the composer's discovery of the US, but it also has some worrying moments. And this show is about exploring how to create better outcomes for investors. So I'm normally trying to find technologies, ideas that contribute to that and to play a tiny role in pushing them. Here, we're going to look at it the opposite way, how you can manufacture bad outcomes and still thrive as a business. This may sound a bit crazy because investment management is built on performance over the long term, but I think that with Yieldstreet, a company that's now rebranded to Willow Wealth, I found a pretty good example. I've been following the company without paying too much attention to it until last June, where I saw in the same page of news that Yieldstreet announced it had secured a new big round of funding. And next to it, there was this article about how Yieldstreet real estate bets left customers with massive losses. It's quite rare to have two pieces of news like that next to each other. So that was my starting point. If you're not familiar with the company, the clue is in the name, the old name, Yieldstreet. Through this personal investigation, I found out that the model of Yieldstreet is actually not about delivering yield. I am George Aliferis. Enjoy this due diligence episode of Investology. This episode will be structured in two parts. First, it's going to be my own investigation and narration on Yieldstreet itself, its business model, its marketing, its products, and also its latest round of investment. In the second part, I have the absolute privilege to talk to someone who has been an investor and lost money on the platform and has very kindly accepted to share his experience with us so that others can learn from it and avoid the same mistakes. Our starting point will be a CNBC article, When Invest Like the 1% Fails, how Yieldstreet's real estate bets left customers with massive losses, where Justin is actually featured. And it recalls some of the big losses that occurred on real estate deals in the US. Obviously, when you hear news like that, someone losing all its money, it could be bad luck, right? And then the news pick it up, but sometimes it happens. Here, it's not that case because the article focuses on one specific real estate bet, but it also says that of 30 deals that CNBC reviewed, 4 have been declared total losses by Yieldstreet, and of the rest, 23 are deemed to be on a watch list, which means that it's not sure whether the investors will recoup their capital or any capital at all. So that brings the next question, which could be, it's unfortunate. It might be a bad bet on an asset class at the wrong time, but there is something to me that seems paradoxical at first, is how do you lose all your money on a real estate deal? Because that's the magic of buying real estate, right? Stocks can go up and down. Company can go as bad as bankrupt. So even your bonds are never secured. But if you buy a house, you're not guaranteed to make money, but somehow you don't imagine that you're going to lose all of it. In fact, I think that even if it's hit by a meteorite, as insurance is compulsory, you wouldn't lose all your money. We're going to explore how it works, but really it brings the question of, is there something inherent in Yieldstreet product and something that makes those losses more systematic and more about the nature of the business and the product itself? So let's examine the business of Yieldstreet. Now, if I look at the article from CNBC, it features quite a few male investors who must be high-income earners because they've lost hundreds of thousands typically, but are not filthy rich, and they're, I guess, in their 30s, 40s. And the rationale is very clear. It's about this investing like the 1%. It's about diversification, and it's about yield. And yield typically is something that implies a limited amount of risk, right? So you can't think of yield without thinking of the risk. And really, when you think about it, if you invest in stuff where you consider that there's a chance to go to zero, then it never makes sense unless you're extremely diversified, because even if your yield is 10% on everything else and successful, it's very hard to recoup your capital. So that's kind of the nature of the yield, but it's clearly where Yieldstreet or Willow Wealth is positioned. If I look at the different investment opportunities on the website, it's typically about yield, income. The keywords are loan portfolio, diversified income, credit, leasing, and there is the high yield short-term note, which is kind of their flagship product. I see that the maturities vary from 6 years to just a few months. Those are all private assets, which are only available to accredited investors. So you need to certify yourself, you need to have a certain amount of wealth, etc. Accredited investors still consider retail investors because they're not institutional. And those types of products wouldn't be available a few years ago. This is the democratization of investing. That is a very big trend, and Yieldstreet is one of the champions of that. If we stay on the surface level, there's also something that I find is very striking and very different compared to when you look at a normal, traditional asset manager. There's a lot of tangible elements. For example, I see this power sport loan portfolio, and if I click on it, it's for loans related to motorbikes and stuff like that. There's legal finance. Again, I can understand what it's about. There's the aircraft leasing, and I see that this portfolio actually owns aircraft. There's theater financing. A great part of the appeal is this tangible aspect, which you don't find elsewhere. And of course, that's also very much the case for real estate, which used to be really the bread and butter of Yieldstreet, but I see there's only one real estate link here now. So that's the overview. What I've also seen from Yieldstreet is that they have a very active marketing. Most recently, they sent me a lot of offers where I can get $360 by referring people. They're also very active on social media and do a lot of performance marketing, email marketing, stuff like that. So they definitely adopt the playbook of digital marketing for the modern age. Now we need to go a rank deeper and look at the product specifically. And I'm going to look at one product, which I find particularly striking, particularly tangible, because it's about aircraft leasing portfolio, something that I haven't really seen before and is on Yieldstreet. First, let's look at the overview, and what we see is that there's a target net annual return of 10 to 14%, and there's management fees of 1.5%, annual access fee 0%, one-time commitment fee 0% as well. And there's a risk barometer where I will just try to describe it for the audio listeners. It goes from, lower risk to higher risk, and the cursor for this particular product, I would say, is perhaps 40%, so on the lower risk side. And the exposure is a diversified portfolio of aircraft on lease major airlines. It's about buying aircraft, leasing them, getting the yield, paying, of course, the expenses and the debt, etc., that the portfolio has taken in order to be able to purchase that, and then also managing those aircraft, so selling them back potentially and keep going. Although I'm not an aircraft specialist, it feels like something that's very understandable. And there are different arguments that it's quarterly income, it's diversified, there's tailwinds that support aircraft leasing. All sounds pretty good. And there's details about the aircraft, etc. I think this is really something quite cool that you really know what the planes are, where they're going, because they tell you which companies. And another important point is that there's potential downside protection. So this is the risk part that we're talking about as we talk about yield, but it's pretty vague. It says it's conservative and that there's insurance. So if the aircraft falls out of the sky, well, we don't talk about the human loss, but yes, we should recover our price. And then the originator is an affiliate of Blue Owl, which is a massive private asset firm. They seem to know what they're doing. It's not like it's a new player that doesn't understand this thing. This is kind of the pitch. I've tried to give you an idea without reading through the whole thing of what I see on the website, but I'm just going to go through this capital chart. It says, Yieldstreet is participating in the equity position of a joint venture with Creston Air Partners LLC and an affiliate of Blue Owl. The portfolio will be financed with leverage provided by a top 10 global bank by assets. Not all the information, but at least we know what it is. And I want to pay attention to this word here, the equity position. And funnily enough, this word is only mentioned once in terms of the nature of the deal. So as I open the document, I see it's 96 pages of small print. So don't worry, we will not go through that, but I will try to guide you through the essentials. So we're jumping straight to page 7, where we see the exact details of the deal. It's about 100 million in total, and is about 51% of senior debt. We see somewhere that for this debt, they have to pay treasury rate plus 2.695%. And then there's the equity, which is 49%, where our fund sits along with the majority investor. And if you look at the cost of servicing the debt, plus the yield from the lease, plus the expense, etc., and you divide it by the total amount of equity, it's aiming at 13%, which after fees corresponds to the target yield for our note. One way to understand this is to look at it from a different point of view, to see what the senior debt holders get and what role equity plays for them. So the senior debt holder will get Fed rates plus about 2.7%, so something close to 7%. And if you look at the risk, what it means is that they will not be affected unless the deal loses more than 50% of its value. And that's where we come to this definition of equity here. And obviously, the irony of talking about yield when it's called equity is not lost on me, but it's a term to specify that this is the tranche, the segment of the deal that will be absorbing all the losses. And that's what the Yieldstreet investor will have in effect. What it means, and I've crunched the number, is that the aircraft value would need to fall by 51% before the senior debt starts to lose money. In other words, if the aircraft value falls by 51%, your capital in this product is totally eradicated. What that also means is that if there is full repayment, so if we make a simple assumption that there's full repayment, the equity slice is going to get about 13%. I've been doing this interesting number crunching to try to understand the risks, and I assume that the lease is the same, but the aircraft lose value over time. If it's a drop of 5%, your capital is essentially 100% preserved, but anything more than that, then you start losing capital. And if they drop by 20%, you will get about 60% of your capital. And if they drop by or 50%, then you're completely wiped out. And you might think this is highly unlikely. What you need to really consider in a product like that is it possible that aircraft lose 5 to 10% of their value? I don't know how it works, but it doesn't seem like a crazy outcome. I didn't even go into the details of the memorandum, and really there's things here that are outside of the structuring of the deal in equity. Very briefly, the upside is actually limited if there is a full recovery. The GP take some of the upside. The expenses are unlimited. And also a funny thing that the fees can be waived for Yieldstreet employees. This is just a few things in a 96-page document, but you can clearly see who it is written for in terms of outcome. I don't have the details of the real estate deal, but that explains that mystery that I started with. How can you lose all your money on something that should never go to zero, like a house, and those houses in the real estate deal are still there? It's because of the way it's structured. It's because it's typically using the equity tranche of the deal, which means that the investors in those deals through Yieldstreet will absorb all the losses. This is not an isolated case. Yieldstreet was also charged by the SEC for misleading investors. You must have seen the big news in the credit world recently with the collapse of First Brand. Yieldstreet was also involved in funding First Brand, but somehow here they managed to escape early. But that means that they live in this dangerous side of credit. And even when it's not a dangerous side of credit, it's about taking the most risky part of any deal. So I'm trying to find broader lessons here in terms of the business of Yieldstreet. In essence, many of those deals are equity, or they might be called junior parts of the debt. And this is not what we retail investors normally perceive as yield. It's called an equity because it's an equity type of risk. And that also means that when we see, as Yieldstreet often repeats, that it's collateralized or backed by a diversified portfolio, this is actually not the case, because if you're the equity tranche, you will take any loss on the portfolio. What's also very surprising in the way Yieldstreet is approached and how different it is from, private equity firms who typically say that, well, like Blackstone, who says, we don't lose money, that's their motto, is that Yieldstreet seem to have let it collapse for investors. So I cannot access the exact deal of the failed Nashville property, but what you can see in the release after it collapsed is that, well, there were attempted recovery efforts, but there's something that really perplexed me. And it explains, given the continued dynamics in downtown Nashville, including a current vacancy rate exceeding 15% per the latest CoStar data, and the expectation of higher for longer interest rates, we determined that additional capital infusion would not likely change this outcome. So this is kind of understandable. It's a cold and rational judgment on the deal. What surprised me comes later. Therefore, a sale was the most prudent option on behalf of investors. So what it tells us here is that this property was not a total loss, and that Yieldstreet and the sponsor have been considering all the investors, yet the investors in Yieldstreet have got nothing. And that's normal because they absorbed the loss. They were probably on the equity tranche, etc. But it tells a lot about the approach of Yieldstreet, which is clearly not to fight to the end for investors. And there was a similar issue with some boat being leased, etc. And again, Yieldstreet did some attempt at recovery and engaged lawyers and got some money back, but then announced that the legal costs were so high that there is no money left for investors. So it's very unlike the traditional private equity firms or private asset firms who boast about their track record and typically try hard not to lose money. It seems like Yieldstreet is flipping this private asset playbook, and their track record actually speaks for itself. It's a self-reported 6.6% across all asset classes during a period where private assets, public assets have all grown by double digits. And that includes private credit, which is kind of their segment. And therefore, it's really a terrible statement and something that, I don't think a budding private equity firm could build on, right? It would probably close down if it had such a disastrous start, and also the 6.6% self-reported, and it doesn't include the potential heavy losses that will occur in other real estate deals. Actually, this early performance, this consistency of early performance in private equity is something that I discussed with a previous guest and private equity professor at Oxford, Ludovic Fast.
That's pretty normal for about any private equity firm, because when you start, either it goes well and you stay, or it goes badly and you get out, right?
So it's really the nature of the business. It's an industry built on track record and continuity, and where those that don't perform early simply disappear. It also means that normally it doesn't matter how good your sales are, your marketing is, people really start by looking at this, and then they might look at your process and other stuff. So that's the traditional model. So how does Yieldstreet flip that? Well, clearly, the track record is not their selling point. Although all the private equity firms, private asset firms are now expanding into retail, their assets traditionally are linked to institutional investors. Willow Wealth is retail from the start, and it means that there is no such thing as deep due diligence before a product is bought. The business of Yieldstreet is to offer high headline numbers in terms of potential returns, potential income. And in order to get those double-digit headline numbers, as we can see in most of the deals on their platform, you need to have very aggressive structuring and offer the equity tranche of the deals, the most risky one. And that means as well that you will suffer losses. You could imagine an overall positive return if people were diversified, if the firm that was managing this was highly skilled and very specialized into this, and also if they had access to the very best deals. And that's a point that CNBC raises, that Yieldstreet might just be getting what everyone else has left on the table. There is structurally something in Yieldstreet that does not allow to deliver better outcomes for investors globally over the long term. They are making changes, though, by offering a more basket approach rather than single investments, and also evergreen funds, which are managed by other people. If you consider there are 24 million millionaires in the US alone, they have a very big target market. And I think they must also expect a lot of churn, because if anyone is burned through the product, they will not return. But it doesn't matter if you've got such a big and not yet penetrated market. And therefore, what you can do is work on the marketing, keep presenting products where you can mention those key points of high yield, diversification, invest like the 1%, and don't worry too much about the returns. I think there's some lessons for firms that want to deliver better outcome, because outcomes are not everything. And sometimes you may have a bad year or something like that while still having the best possible process. So how do you deal with that? We can see the story and the fact that you grab the attention of your audience really matters, whether you want it or not. You are competing with people who will oversimplify the message and oversell and hide the risks. So you just have to fight on the attention as well. I also think that this tangible aspect of the deal is something that is very important and very attractive to people, and that if asset managers or other types of players manage to make the offer more tangible, to explain to people what they really are going to invest in, to make them feel it, even if it's sometimes hard. But that's also a very important aspect. You also have to guide your investors about the risk and about the things that they should look out for. The process is essential, but it comes later. For investors, that's really the ultimate thing that matters, but not the first. That means that, yes, they should absolutely read the memorandum, but before reading the memorandum, there's probably a lot of steps